Okay, it's earnings season around the world, and Nigerian market is not an exception. So let's get a sense of our earnings seasons that started about a few days ago, and of course from early last week. Let's choose some of these earnings over with Victor Chiaza, who's the head of research at FSL Securities, is live to us from the stock exchange trading floor in downtown Lagos. Good morning, Victor.
Morning, Bosun.
Great. Let's hit the ground. Let's hit the ground running with the banks. The big banks are yet to report, as it were, with the exception of Stanbic, IBTC, which is a holding company, and FBN Holdings. But we have Fidelity Bank, we have Sterling Bank, we have FCMB. What's your reading of these early cutting raises when it comes to the earnings reporting season on the exchange with the banks?
Yeah, Bosun. This is quite a new trajectory we're heading into right now, because the wave of results we're seeing in the market, we're not used to what we're observing in the recent weeks. Because for full-year results, the market is actually used to receiving audited numbers, where investors can actually take decisions and see the results after it has been audited. But what we've seen this year has been that most of the banks and most companies have decided to release unaudited full-year statements to the market to prepare the markets ahead of the audited results that will be hitting the market. And pushing out your results earlier than after it has been audited, it has its pros and it has its cons. So there are risks where you push your results and investors react negatively because they don't understand what you've sent to the market. And it might also mean a cutting raise. Many people can expect improved performance, improved dividend once they see your numbers after it has been audited. So I think the market needs to weigh it and decide which one it wants to pick and how it wants to invest, given the information it has available to it. But with regards to the banks, the likes of Sterling Bank, the likes of First Bank, the likes of Fidelity, they've all released their unaudited full-year numbers to the market. And what we observe with these numbers has been that most of them, aside from Fidelity, we've not seen any significant increase in terms of interest income for most of the banks, especially given that that line item is the main line item that should actually be returning improved numbers for the banks. Apart from the likes of Fidelity that posted interest income increase, a rise in interest income of about 16%. First Bank, Sterling Bank, and Stanbic didn't post that much. Most of their interest income were more or less between the 1% and 2% increase, and that didn't pose well to the investing public. However, they were able to adjust their performance given other line items, especially coming in from their fee and commission income, especially underneath it, the electronic fee income, which we saw most of them report increased performance. For the likes of Fidelity Bank, we saw fee and commission income increased by 24%. Same thing for Sterling Bank. First Bank saw fee and commission income grow by 11%. So we've seen that they're using the other line items on their income statement to adjust their bottom line. First Bank, overall, we saw a decent performance in terms of a reduction in impairment charge. We saw impairment charge drop by about 52%. But that gain that was also gotten from that space was more or less thrown away, as we saw the bank report about 29% rise in its operating expense from 147 billion to 190 billion. Profit after tax grew by a mere 3%. I think for the likes of First Bank reporting about 11% PBT, I think that bank still has a long way to go, because if you compare it to peers in the tier 1 space, the likes of GT, the likes of Zenith, GT has about 40 to 50% profit before tax margin, while Zenith is reporting above 30% PBT margin. So for a bank like First Bank that is reporting an 11 to 12% PBT margin, shows you the bank still has a long way to catch up with its competitors, the likes of GT and Zenith. Once that bank can push those margins up, I believe that we can see
Victor, a quick one with the banks,
Right.
so that we can leave the banks. A quick one. The big story last year has to do with loans and advances, expanding the credit basket to the various segments of the economy that the central bank aggressively pursued. So I'm looking at the net loans and advances. This seem to be increasing for some of the banks that we've seen their numbers. Fidelity is reporting about 34% increase in net loans and advances. FCMB are also reporting about 13.3%. Do you think this bank's earnings for 2019 will give us the clear picture or the full impact of the monetary policy, unorthodox or heterodox policy focus of the central bank of 2019?
Yeah, boss, but I don't think the 2019 numbers will give us a clear picture, because I feel that is a starting point, and we might not begin to see the real impact of these loans, because it takes a while. It takes a while for any loan to actually you can actually classify a loan as a bad loan or an intending bad loan. So I think for now we might think the banks might actually sit pretty on their current positions. But if you look across board, we notice that the loan to deposit ratio that the CBN has imposed on the banks is actually working, because across board we've seen a rise in loan to deposit ratio and their loan book. Most of the loans the banks are actually pushing out actually pushed their loans this year against 2018 higher, except for the likes of Sterling Bank. If you look at Sterling Bank's loan book, it actually contracted by about 1%. So apart from Sterling Bank, I think other banks we've seen their loan books actually grow for 2019. But we need to keep a close eye on that space for the year 2020, because that is when we might begin to classify most of these loans to performing and non-performing. And once that risk begin to crystallize, we might begin to see NPLs rise to levels where most of these banks might not be able to pay out dividends.
Interesting. It's still early days. We have the smaller banks. Then when the big boys report, we will all have to continue the conversation. But hold on a second. Look at the consumer goods. The numbers coming from some of the brewing companies are not impressive at all, if I want to put it very mildly. International Breweries PLC, that's a negative 9 billion naira. Nigerian Breweries is doing another round of commercial papers, 45 billion, series 5 and 6, trying to shore up his operating funds, as it were. Guinness is still in negative territory. EBITDA is seriously negative. So what's the big picture here for the consumer goods sector, Victor? Is this still the weakness in consumer disposable income?
Yeah, Bosin, you just hit the nail on the head. The reality is that for 2019, the consumer disposable income was more or less weak. Consumer wallet was significantly under pressure, and we all know that the excise duty that was put in place in 2018 has continued to bite those that are in the brewery sector. So once your consumers are actually moving from premium brands to more or less value brand, or even more or less lower brands, you begin to see that competition toughen in that space, and that's what has hit most of the players in the consumer goods sector. But aside that, if you also look at the likes of Guinness, the likes of Nigerian breweries, and the likes of international breweries, Nigerian breweries just released its result, and it posted a profit before tax, a loss before tax of about 13.3 billion, and a loss after tax of 9 billion. It shows you that company is significantly under some form of pressure. If you look at the income statement, top line was down, bottom line was a loss. So, and if you recall, international breweries raised about 164 billion in terms of rights issue December last year. If you look at their numbers, that has not impacted on their balance sheet. I expect that once that hits their balance sheet, we might see a better and improved performance in 2020. Though, if you look at the numbers, finance cost was not the only issue the brewer had to face. The brewer needs to actually get his income statement adjusted and actually watch his costs, because the company currently has about 272 billion in debt, both short-term and long-term. So I believe once this rights issue impacts their balance sheet, we might see that debt level reduce and finance costs drop Victor, significantly.
Victor.
But, whether they like it or not, they need to...
Yes, sorry, Victor. We
Yeah,
need to
go
wrap
on.
up the. We need to wrap up the conversation. Thank you so much for coming to. I was just about to ask you if you're one of those who's changing your brand in terms of what you drink. But I'm sticking with green tea and some lemon slices here, and that's what I just have here with me in the studio. So perhaps this all is affecting the brewing companies, their international breweries. Guinness. Apologies to those guys. They're in big business. They're great job creators in the economy, and they pay big tax to the authorities. We all appreciate what they're doing in the brewing sector. Thank you so much, Victor. We appreciate you coming through, the head of research at FSL Securities. We'll take a break. We'll be right back in just 1 minute, everyone.